Let me tell you about the day I stopped losing money. It wasn't when I learned some secret pattern. It wasn't when I found the perfect indicator. It was the day I deleted every single chart from my screen. Except one, the 1 hour chart. Sounds too simple, right? That's exactly why it works. For 3 years, I had 15 different time frames open. I'd check the monthly, the weekly, the daily, the 4 hour, the 1 hour, the 15 minute, the 5 minute, sometimes even the 1 minute. I thought more information meant better decisions. I was wrong. More information just meant more confusion, more second guessing, more ways to talk myself out of good trades and into bad ones. Then I met a trader who'd been consistently profitable for 8 years. I asked him his secret. He laughed and said, "I only look at one chart, the 1 hour, nothing else." I thought he was joking. He wasn't. He walked me through his entire process, 5 simple steps. He followed every single day, no complexity, no confusion, just a clear systematic approach that worked. I'm going to walk you through those exact 5 steps today. The same framework that took me from inconsistent and frustrated to profitable and calm. And at the very end, I'll show you the one adjustment to this system that most traders never figure out. This single tweak is what separates traders who stay consistent for months from traders who stay consistent for years. Miss this final piece and you'll eventually fall back into old patterns. Let's get into it. Before I show you the 5 steps you need to understand why the 1 hour chart is the sweet spot, it's not random, it's not my preference, it's based on how markets actually move and how human psychology actually works. The 1 hour chart sits in the perfect middle ground. It's fast enough that you get multiple setups per week. You're not waiting days for one trade like you would on the daily chart, but it's slow enough that noise gets filtered out. You're not getting whipsawed by every tiny move like you would on the 5-minute chart. Think about it like this. If you're trying to navigate across a city, you could zoom your map all the way in and see every single street, every alley, every detail. But you'd get lost in information. You wouldn't see the bigger picture. Or you could zoom all the way out and see the entire region. But now you can't see enough detail to actually navigate. The 1 hour chart is like zooming to the perfect level where you can see both the route and the details. Here's another reason the 1 hour works. It matches human attention spans. You can check a 1 hour chart 3 to 4 times per day and catch every important move. You don't need to be glued to your screen. You don't need alerts going off every 5 minutes. You can have a life outside of trading while still capturing your edge. I used to trade the 15-minute chart. I'd sit at my computer for 8 hours straight. By hour 6, I was mentally exhausted. My decisions quality dropped. I'd start making mistakes. I'd take trades I shouldn't take. I'd exit trades I should hold. Trading became this grueling, exhausting process. Switching to the 1 hour changed that completely. Now I check my charts 4 times per day. That's it, morning. When the market opens, midday, afternoon, and before close, each check takes maybe 10 minutes. I'm in and out. The rest of my day belongs to me, but I'm not missing opportunities because the 1 hour captures everything that matters. The 1 hour also removes the temptation to overtrade. When you're watching a 5-minute chart, you see setups constantly. Most of them are garbage, but they look appealing in the moment. You take too many trades, you dilute your edge. The 1 hour forces patience. Setups don't appear every hour. They appear maybe once or twice per day. This natural limitation protects you from yourself. All right, here's step 1 of the 5-step framework. Identify the trend on the 1 hour chart. Not the daily trend, not the 4-hour trend, just the 1 hour. This is your entire universe now. If the 1 hour chart is trending up, you're looking for longs. If it's trending down, you're looking for shorts. If it's ranging, you're staying out. Here's how you identify trend. And this is so simple. A kid could do it. Draw a line connecting the recent swing highs. Draw a line connecting the recent swing lows. If both lines are pointing up, you're in an uptrend. If both lines are pointing down, you're in a downtrend. If one is up and one is down, or they're both flat, you're in a range. That's it. No complicated indicators, no multi-time frame analysis, no trying to predict what's going to happen next. You're just identifying what is happening right now on this one chart. Traders complicate this because simple feels like it can't work, but simple is exactly what works. I remember when I first started using this approach, I felt like I was missing something. Where are all the other confirmations? Where's the volume analysis? Where's the RSI? Where's the MACD? I kept wanting to add more, but I forced myself to stick with just trend identification for 2 weeks. Those 2 weeks I made more money than the previous 2 months combined. Why? Because I wasn't second-guessing myself. I wasn't getting conflicting signals from different time frames. I wasn't paralyzed by too much information. I just looked at the chart, identified the trend, and traded in that direction when the trend was unclear. I did nothing. Clarity creates confidence. Confidence creates execution. Execution creates results. Here's a key point about trends on the 1 hour. They don't last forever. You might get a strong uptrend for 2 days. Then it shifts to a range, then shifts to a downtrend. You're not trying to predict these changes. You're just recognizing them when they happen. Every time you check your chart, you're asking the same question. What is the trend right now? Not what was it yesterday. Not what will it be tomorrow, right now. This keeps you adaptive. You're not married to a bias. You're not holding on to an outdated view of the market. You're responding to current reality, and current reality is all that matters in trading. Step 2, wait for the pullback. This is where most traders fail. They identify the trend correctly. Let's say it's an uptrend. Then they immediately buy. They chase the move, they enter at the high, then price pulls back and stops them out. They just bought at the worst possible spot. Here's the rule. If the trend is up, you wait for price to pull back to support before buying. If the trend is down, you wait for price to pull back to resistance before selling. You're not chasing. You're waiting for the market to come to you. This requires patience. Patience is the hardest skill in trading. Think about shopping. If you want to buy something, do you pay full price or do you wait for a sale? You wait for a sale, right? Trading is identical. You want to buy in an uptrend, but you want to buy on discount. You want to sell in a downtrend, but you want to sell at a premium. Pullbacks are your sale prices. On the 1 hour chart, pullbacks are obvious. You'll see price moving up, making higher highs and higher lows. Then it pauses, comes back down, finds support at a previous high. That's your pullback. That's your entry zone. You're not trying to catch the exact bottom of the pullback. You're just waiting for price to return to value. I used to struggle with this. I'd see an uptrend and I'd want in immediately. I couldn't wait. I'd buy at the top of the move, watch it pull back against me, panic, sell, then watch it resume higher without me. This cycle repeated for months until I learned to just wait, let the pullback happen, let price come to support, then enter. Here's how you identify support in an uptrend on the 1 hour. Look at the previous swing high. When price pulls back to that level, it often finds support there. Why? Because that's where buyers previously stepped in. They're likely to step in again. This creates a high probability zone. You're not guessing, you're using market structure. Same thing in downtrends, but inverted. You're waiting for price to rally back to resistance. Resistance is the previous swing low. Sellers showed up there before. They'll likely show up again. This is your entry zone for shorts. The beautiful thing about waiting for pullbacks is it dramatically improves your risk reward. When you chase, you might risk 50 pips to make 50 pips, 1-to-1. But when you wait for the pullback, you might risk 30 pips to make 70 pips, better than 2-to-1. Same trade, better execution, better results. Step 3, confirm with price action before entering. Just because price pulled back to support doesn't mean you enter blindly. You wait for confirmation that buyers are actually showing up. This is the difference between a good entry and a great entry. Here's what confirmation looks like on the 1 hour chart. Price pulls back to your support zone. Then you see a bullish engulfing candle, or a hammer, or a strong close above the previous candle's high. These patterns show rejection of lower prices. They show buyers stepping in. That's your signal to enter. Same thing for shorts. Price rallies to resistance. You wait for a bearish engulfing, or a shooting star, or a strong close below the previous candle's low. This shows sellers are defending that level. That's your confirmation. I know what you're thinking. This sounds like you're adding complexity back in. You're not. You're just waiting for the market to prove your idea is correct before risking money. There's a massive difference between complicated multi-indicator systems and simple price-based confirmation. Let me tell you a story. I once had a perfect setup. Uptrend. Price pulled back to support. Everything looked great. I entered immediately without waiting for confirmation. The candle closed as a shooting star. Bearish signal. Price dropped right through support and stopped me out. I lost because I was impatient. The next time the same setup appeared, I waited. Price pulled back to support. I didn't enter, I watched the next candle. It was indecisive. I still didn't enter. The candle after that was a strong bullish close. Buyers were showing up. I entered. The trade worked perfectly. Same setup, different execution, different result. Confirmation adds maybe 1 or 2 candles of wait time, but it dramatically increases your win rate. You're filtering out the false signals, the traps, the areas where support looks good but doesn't actually hold. This small addition of patience separates break-even traders from profitable traders. Here's another benefit of waiting for confirmation. It gives you a clear stop-loss level. If you enter on a bullish engulfing candle, your stop goes just below that. Candles low, tight stop, clear invalidation. If price goes there, your idea was wrong, no debate, no hoping, just exit and wait for the next setup. Step 4, manage the trade. This is where most traders sabotage themselves. They get the entry right. The trade moves in their favor, then they mess it up. They exit too early. They move their stop. They start overthinking. Management is where discipline matters most. Here's the simple management rule for the 1-hour chart. Set your stop below the confirmation candle. Set your target at the next resistance level in an uptrend or the next support level in a downtrend, then don't touch it. Let the trade resolve. That's it. No micromanaging, no checking every 15 minutes, no second guessing. The 1-hour chart makes this easy because you're not watching every tick. You check in a few times per day. You see if your stop was hit or your target was hit. If neither happened, the trade is still active, you move on with your life. This detachment is crucial. Attachment creates emotional decisions. Emotional decisions create losses. I used to manage trades terribly. I'd enter a position, watch it move in my favor, get excited. Then as soon as I saw any pullback, I'd panic and exit. I'd lock in tiny profits thinking I was being smart. I was actually being fearful. I was leaving massive money on the table because I couldn't handle normal price movement. Switching to the 1-hour forced me to stop micromanaging. I'd enter a trade in the morning, check it at lunch. If it was still running, I'd leave it alone, check it before close, see if it hit target or stop. That rhythm removed my ability to make fear-based decisions. I couldn't exit early because I wasn't watching. The trade either worked or it didn't. Here's another management rule. Don't move your stop closer to protect profit. I know this sounds counterintuitive, but moving your stop tighter usually just gets you stopped out on normal volatility. You had a reason for placing your stop, where you placed it. That reason doesn't change just because the trade is in profit. The only time you move your stop is to lock in profit after the trade has moved significantly. If you're up 200 pips, you might move your stop to break even. That's fine, but don't do this immediately. Let the trade breathe, let it develop, give your edge room to work. 1-hour charts have natural volatility. Candles can have 20 to 30 pip wicks. If you set your stop too tight, you'll get stopped out by noise. Your original stop placement based on structure is almost always better than any adjustment you make mid-trade. Step 5. Review and repeat. At the end of each day, you review every trade you took, not to beat yourself up, to extract lessons. You're asking specific questions. Did I wait for the pullback? Did I get confirmation? Did I follow my management rules? Did I let emotions interfere? This review takes maybe 5 minutes, but it's the most important 5 minutes of your trading day. This is where improvement happens, not during the trade. After the trade, you're building self-awareness. You're identifying patterns in your behavior. You're reinforcing good habits and catching bad ones early. I keep a simple journal. Each trade gets 4 sentences. What was the setup? Why did I take it? What was the result? What did I learn? That's it. No elaborate documentation, no screenshots. Unless something unusual happened, just quick notes that build a database of experience over time. Here's what I discovered through reviewing. I had a pattern of taking trades right before major news events. I didn't realize I was doing this until I reviewed 30 trades and saw it kept happening. Once I saw the pattern I could fix it, I added a rule. No trades 1 hour before major news. My win rate improved immediately. You can't fix what you don't measure. You can't improve what you don't review. Most traders skip this step because it's not exciting. It doesn't feel like trading, but this is where trading actually happens. In the review, in the analysis of your own behavior, in the commitment to getting better, one trade at a time. The repeat part is just as important. You're doing the same 5 steps every single day. Identify trend on the 1 hour, wait for pullback. confirm with price action, manage the trade, review, and repeat. This repetition builds mastery. Mastery builds consistency. Consistency builds profitability. After doing this for 6 months, it becomes automatic. You don't think about the steps anymore. You just execute them. Your brain has built neural pathways. You see a setup, and you know instantly if it's valid. You don't debate. You don't second guess. You just execute. That's when trading becomes easy. Before I show you the one adjustment that takes this system from good to exceptional, the tweak that keeps you consistent for years, not just months, make sure to hit that subscribe button to support the channel. All right, here's the final piece. Here's the one thing most traders miss that causes them to eventually abandon even the best system. They don't account for changing market conditions. They learn the 5 steps, they execute them perfectly, they make money for a few months, then the market shifts from trending to ranging, and their system stops working. They panic. They think the system is broken. They start changing things. They lose the discipline that made them profitable. The adjustment is simple. You need 2 modes, trending mode and ranging mode. The 5 steps I showed you work perfectly in trending markets. But when the market shifts to a range, you need to shift your approach. You're still using the 1-hour chart. You're still following a systematic process, but the process looks different. In ranging mode, you're doing the opposite of trending mode. Instead of waiting for pullbacks to support and buying, you're waiting for price to hit the top of the range and selling. Instead of waiting for rallies to resistance and selling, you're waiting for price to hit the bottom of the range and buying. You're fading the extremes instead of following the trend. How do you know when to switch modes? It's simple. If the 1-hour chart shows price bouncing between the same high and the same low multiple times, you're in a range. If price is making higher highs and higher lows, or lower highs and lower lows, you're trending. You check this every day. You adjust your mode accordingly. This flexibility is what keeps you profitable long term. You're not fighting the market. You're adapting to what the market is giving you. Some traders are pure trend followers. They make money in trends and give it back in ranges. Some traders are pure range traders. They make money in ranges and give it back in trends. You need to be both. I resisted this for a long time. I wanted one system that worked in all conditions. That doesn't exist. Markets change, they trend, they range, they chop, they're volatile, they're quiet. You need to change with them. Not your core principles, just your tactical approach. Here's how I implement this. Every Sunday I look at the 1-hour chart. I identify if we're trending or ranging. I write down my mode for the week, trending mode or ranging mode. Then I follow the appropriate process. Some weeks I'm looking for trend continuation, some weeks I'm fading extremes. I'm always systematic, just contextually aware. This one adjustment transformed my consistency. I went from making money 3 months, then giving it back the 4th month, to making money consistently, month after month. Not because I got better at predicting markets, because I stopped trying to predict and started responding. The traders who last 10 years in this game aren't the ones with the perfect system. They're the ones who adapt, who recognize when conditions change, who adjust their approach without abandoning their discipline. That's the real skill, not rigidity. Flexibility within structure. So there's your complete framework, 1 chart, the 1 hour, 5 steps, identify trend, wait for pullback, confirm with price action, manage the trade, review and repeat, plus the critical adjustment. Switch between trending mode and ranging mode based on current conditions. This system works because it's simple enough to execute consistently, but robust enough to adapt to changing markets. You're not trying to be perfect. You're trying to be systematic. You're not trying to predict everything. You're trying to respond to what's actually happening. If you implement this exactly as I showed you, if you commit to only the 1-hour chart for the next 3 months, if you follow the 5 steps without deviation, if you adapt your mode when the market changes, you will see improvement, not magic overnight success, real, gradual, sustainable improvement. Trading doesn't reward complexity. It rewards consistency. This framework gives you both, a simple process you can execute day after day, and the flexibility to stay profitable when conditions shift. If this helped, drop a comment, let me know, and subscribe to Trading Dosage for more straightforward frameworks that actually work. The 1-hour chart changed my trading completely. It can change yours too. See you in the next one.